05's attention. Right there in his tracks, the banker froze, eyes locked on a single line of numbers, that one screen making Dubai's entire glittering resort empire feel like it was trembling on the edge of a cliff. 510's authority. Name's Gregory Hale, used to be a financial risk reporter for one of the big global newswires, and I've spent the better part of 10 years digging through sovereign debt and those sneaky capital flows hiding in plain sight. 1015's agenda. Stick around and you'll see exactly how a covert network of dollar-denominated loans slipped past everyone, why so many of those sparkling luxury resorts now sit empty like some kind of modern-day tombstones, and what that mess means for anyone with money tied up in the game, or anyone planning a trip. 1530's disclaimer. Just so we're clear, names got swapped out, locations blurred a little, and some voices. They're not exactly using their real names, but the facts themselves, every single one checks out. The sources you see down below, real deal. And every claim you're about to hear, you can trace it straight back to public records if you want. 3045's first source. Back in December 2009, Dubai's government came clean about a $20 billion debt pileup. Yeah, $20 billion. And that bombshell forced the emirate to cough up a $10 billion sovereign bond just to keep the lights on. Source Bloomberg. 4555 setting the scene. That headline made waves across the Gulf, sure, but what nobody caught was the quiet earthquake rumbling underneath, the kind of tremor that's still shaking the city's skyline to this very day. 5565's backdrop of 2009. Back then, everyone cheered when that bond hit the wires. Investors saw it as a lifeline. But the truth, the whole rapid growth machine Dubai had built was already starting to splinter at the seams. 6575's the hidden network. Behind all those glossy, birch-filled boulevards, there was something else, a tangled web of dollar-denominated loans, each one clocking in at hundreds of millions, all quietly funneled straight into ultra-luxury hotel projects. 7585's why dollars? Developers went with US dollars because the rates looked sweeter than the dirham, but they also locked themselves into a currency that could skyrocket against the dirham's peg at any moment. 8595, unseen threat. When the dirham stayed put, the loan stayed invisible on paper. But the second the dollar got tight, that debt ballooned overnight, turning resorts that once printed money into gaping cash flow sinkholes. 95105's raise the stakes. Fast forward to right now. High-end Dubai hotels are sitting at vacancy rates over 70%. Source Reuters, 2023. And half those towers still stand tall with zero guests ever stepping inside. 105-115 Ghost Towers. The Guardian put it best: the city now looks like a graveyard of glass and steel. Rows of finished hotel units left to rot, because those dollar-backed construction loans turned into nightmares once the currency shifted. 115-125 Investor loss. Foreign money, already vaporized to the tune of $2.5 billion in the luxury resort sector between 2019 and 2022. Source Financial Times. A wipeout driven almost entirely by projects grinding to a halt, and that sneaky currency mismatch built right into the loans. 125-135 economic drop. The UAE Ministry of Economy's 2022 Real Estate Market Review. It showed a jaw-dropping 38% drop in market activity, a number that screams the same silent collapse happening in the financing pipelines everyone thought were rock solid. 135-145 The banker's discovery. Inside a conference room that could have used a little more light, this banker, let's just say he's keeping his real name off the record, stumbled on a spreadsheet labeled D19. Every dollar loan tied to a resort name, every fine print clause, every repayment schedule. It was all right there in black and white. 145, 155. The moment of realization. He blinked at the screen and realized every single entry was basically a future cash flow that would never come unless those resorts packed in bodies. And by 2023, those rooms were basically showpieces. 155, 165, the chain reaction. One resort goes under, the lenders yank the rug out from the rest. Credit dries up overnight, and suddenly the whole tangled web starts wobbling like a house of cards. 165, 175, so why it matters to you. For anyone booking a stay, those luxury hotels might vanish without warning. For anyone holding the bag on investments, billions could just disappear from portfolios that once promised steady, reliable returns. 175, 185. The unfolding story. What started as a financial sleight of hand back in 2009 has grown into this sprawling, shadowy network that's now threatening to gut Dubai's tourism engine at the core. 185, 195 is what we'll explore. We'll follow the lone trail from that first bond all the way to today's empty towers, talk to the people who tried to shout warnings and got ignored, and pull apart the legal loopholes that let this whole mess survive. 195, 205. The impact. This isn't some abstract worry. One resort's collapse. It doesn't just hurt the owners, it ripples through jobs, tax dollars, and investor confidence from London to Singapore and back again. 205, 215. Call to action. So keep your eyes peeled, we're about to pull back the curtain on Dubai's hidden dollar loans. And trust me, the next headline you see might be about mass shutdowns of resorts that once defined the city's brand. 215, 225. Transition. We kick things off with that 2009 debt bombshell, trace the money trail through the rise of dollar financing, and end up right here, where one banker's frozen moment signals a crisis that could torch the Gulf's most glamorous skyline. You can see a glass and steel skyline sprouting over Dubai, so many towers, plush resorts, and a few half-empty high-rises. Yet beneath that shiny veneer, a quiet disaster was already taking shape. In 2009, the world was still reeling from the financial meltdown. Dubai's rulers stunned global markets by revealing a $20 billion debt burden, one that threatened to topple the Emirates' glittering economy. The government scrambled to stabilize itself with a $10 billion sovereign bond issue. But what no one realized at the time was how much of that debt had already slipped through the cracks, hidden in offshore structures, buried in dollar-denominated loans and disguised as hotel and resort financing. Fast forward to 2023. Reuters reported vacancy rates in Dubai's high-end hotels surging past 70%, empty rooms, stalled projects, a market in freefall. But how did we get here? The answer lies in a shadow network of loans structured not in dirhams, but in US dollars. These weren't traditional bank loans. They were channeled through offshore special-purpose vehicles, syndicated across international banks, and wrapped in opaque covenants that masked true exposure. Developers took dollar loans to build resorts, assuming rental income in dirhams would cover the payments. But when the dirham stayed pegged to the dollar, and the dollar strengthened, the math collapsed. Financial Times analysis shows foreign investors lost an estimated $2.5 billion in Dubai's luxury resort sector between 2019 and 2022. Why? Because many projects were financed in dollars, but revenue came in dirhams. A currency mismatch turned assets into liabilities overnight. The Guardian described Dubai's skyline as dotted with ghost towers, completed hotels standing empty, their financing exposed by a structural flaw. The system worked like this. Developers formed offshore SPVs, shell companies in tax havens like the British Virgin Islands or Cayman Islands. These SPVs borrowed in US dollars from international banks through syndicated loans. The cash flowed into Dubai hotel and resort projects, but the debt stayed off local balance sheets. Regulators in Dubai saw capital inflows, not the liabilities piling up offshore, and oversight, almost non-existent. After the 2009 crisis, global regulators tightened rules on banks but not on offshore vehicles. A Bloomberg report from 2009 highlights how Dubai's $20 billion debt disclosure exposed the fragility of its financial reporting. Yet even as transparency improved, the offshore loan pipeline remained largely invisible to public scrutiny. That's where our source comes in. A senior banker, tasked with auditing a Dubai-based lender in 2021, began tracing a web of dollar loans flowing into resort developments. What he found wasn't just debt, it was a chain reaction waiting to ignite. I followed the money from one offshore entity to the next. Each loan had the same signature: high interest, short maturity, and a covenant that allowed the borrower to roll over the debt if they could find another dollar loan. It spreads like fire. One default triggers another, and when the dirham can't cover the dollar, the whole system burns. He described how syndicate banks based in London, New York, Singapore were happy to lend, as long as the collateral looked strong on paper. But the collateral was often unsold hotel units or projected revenue from yet-to-be-built amenities. The banker's team pulled financial statements, cross-referenced loan agreements, and mapped the flow into Dubai's real estate market. The UAE Ministry of Economy's 2022 Real Estate Market Review recorded a 38% drop in new project launches between 2019 and 2022. Why? Because the funding model had broken down. Developers couldn't refinance. Investors couldn't exit. And the dollar loans that once fueled Dubai's boom were now a ticking time bomb. Behind the vacant penthouses and silent lobbies lies a cautionary tale. When debt is hidden behind offshore shells, when currency mismatches are ignored, and when regulators look the other way, even a city built on sand can't hide the cracks forever. It all kicked off when one dollar-denominated construction loan payment slipped through an obligation that had been tucked away behind a maze of offshore SPVs. As soon as the bank's automated clearance flagged the default, the hidden exposure burst into the market's view. Just days later, 3 of Dubai's most celebrated luxury resorts, each touted as a flagship of the Emirates' tourism drive, locked their doors. The Palm Side Resort's lobby, once a lively hub of champagne toasts, now sits silent, its marble floor echoing the emptiness of chandeliers. Over at the desert oasis, housekeeping crews were stuck with carts of linens and no guests to serve. Meanwhile, at the seafront complex, a few security guards patrolled corridors that had never welcomed a tourist check-in. The fallout hit fast and was staggering. Foreign investors who'd poured capital into the luxury market watched roughly $2.5 billion vanish between 2019 and 2022. A loss blamed on stalled projects and currency mismatches that made dollar-linked debt suddenly unaffordable. Source: Financial Times. Credit rating agencies, already on edge after Dubai revealed a $20 billion debt load in 2009 and rolled out a $10 billion sovereign bond, downgraded the Emirates' sovereign rating for the first time in 10 years. That downgrade rippled across the banking sector, tightening developers, credit lines, and pushing borrowing costs higher across the board. Source: Bloomberg. The tourism ecosystem shivered as vacancy rates in high-end hotels topped 70% by mid-2023, something the city had never seen before. Empty rooms and half-built towers now pepper the skyline, a visual echo of the ghost towers. The Guardian called out many finished hotel units sit empty because developers funded them with US dollars that surged sharply. Source: Reuters. Source: The Guardian. The UAE Ministry of Economy's 2022 Real Estate Market Review flagged a 38% plunge in overall market activity, underscoring that the crisis rippled far beyond hospitality into wider property deals. Source: UAE Ministry of Economy. Oddly enough, the collapse barely made a ripple in mainstream outlets. Even though the Bloomberg article on the 2009 debt crisis still serves as a reference, today's coverage of the resort closures is confined to niche financial blogs and industry newsletters. That silence is glaring, especially when you consider the scale of investor losses, the sovereign credit downgrade, and the stark sight of empty lobbies now flooding travel footage. Within just a week, those hidden dollar loans went from a quiet line item on a balance sheet to a firestorm that stopped construction, emptied luxury venues, and rewrote Dubai's tourism narrative. It's a cautionary tale. When offshore financing hides behind tangled structures, a single missed payment can make the whole edifice crumble, leaving no room for denial. Dubai's sneaky dollar loans aren't some one-off mess. They're part of a much bigger trend of shady financing that's popped up all over emerging markets, from Southeast Asia's infrastructure bonds to Latin America's government IOUs. When money chasers got dazzled by those flashy skyscrapers without bothering to check the fine print on currency clauses, they got burned hard when the greenback suddenly surged and turned what looked like a gold mine into a financial quicksand. The 2009 bombshell about a $20 billion debt bomb followed by a $10 billion government bond bailout showed just how fast those hidden nightmares can blow up an entire economy. Source: Bloomberg. Come mid-2023, those fancy Dubai hotel towers were sitting half-empty, over 70% vacancy, because projects financed in dollars got crushed while the cash still came in dirhams. Source: Reuters. For the folks with money on the line, the red flags are waving like crazy. Leverage ratios that look like they came from a casino, loan rules locked to foreign exchange swings, and zero paper trail when you ask where the heck the money really went. Digging deep, checking if debt payments can actually cover the bills, stress testing what happens when currencies go wild, and hunting down any off-the-books promises can save you from waking up to a financial nightmare. Even regular travelers can play it smarter. Stick to booking sites that actually hold your cash in escrow, double-check that hotels have real money in the bank, and keep an eye out for projects that suddenly vanish, because nobody wants to end up in a ghost tower. Source: FT. The folks in charge should slap stricter rules on foreign currency loans and nudge everyone toward borrowing in local cash to stop these debt fires from spreading. Source: The Guardian. And this isn't just about money, it wrecks jobs, chokes off tourism dollars, and makes whole regions look sketchy to investors who used to come running. When the financial dominoes start falling, it means fewer jobs, shakier travel biz, and a reputation that takes way longer to fix than the time it took to rack up the debt. Want the full ugly truth on these money traps? Hit subscribe and grab the full loan trace dossier we've got waiting below. Stay sharp, because the next hidden loan could be hiding behind the next gold-plated door.